Hello, everyone. My name is Kelly Knoll. I'm a director in our evaluation practice. This is Stephanie Smith. She's a manager in our evaluation practice. Our topic today is fair value accounting. We're going to be talking about a number of things. We're going to focus primarily on business combinations and purchase price allocation. We'll hopefully get into some other things depending on how much time we have left. But we're going to talk all things fair value. The CPE code, right now the 12 CPE code is the value. So I'll give you guys a minute to write that down. The CPE code is the value. Okay, so our agenda for today, we're going to start with some opening comments. We're going to start off talking about ASC 805, that's business combinations, purchase price allocations. Business combinations and purchase price allocations. Then we'll get into ASC 350, that's goodwill and impairment testing. And we'll hopefully get into ASC 360 and 718 after that. So opening comments. Think about the fact that if you looked at McDonald's financial statements, their most valuable assets, their trade name, those arches, though if they were acquired, those are not on its balance sheet currently. So if they were acquired tomorrow, however, they would be on the balance sheet. Then think about Twitter. If you looked at their balance sheet, you pull up Yahoo Finance or anything, you're going to see a book value of equity of $8 million, but their market cap, their market value of equity is going to be 45 million. Also think about two identical companies that own the same assets, could have completely different balance sheets. Also think about the two identical companies can account for intangible assets in completely different ways. So this is just an introduction to say, welcome to the world of fair value accounting, where everything is a hodgepodge of historical cost and fair value. I also want to mention on this, when I mentioned some companies that don't have why the fair value could be more than book value. Accounting says you only restate an asset to its fair value if you acquire it. So for example, say Twitter were to acquire TikTok. Like Twitter's name is not on their balance sheet right now. But if Twitter acquires, say, TikTok, they can put the TikTok name at its fair value on their balance sheet. But their Twitter name never gets to full value unless someone acquires Twitter. Like if a private equity firm comes in and acquires Twitter, then that's when the restatement occurs. That's when Twitter's name gets fair value. So that's why there's kind of this hodgepodge of accounting. The definition of fair value, I want to make sure we touch on that. It's the price that would be received to sell an asset or liability. The price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at a measurement date. So a couple key words in here. Orderly transaction. That assumes it's not a fire sale. Back in like 2008, when kind of the market was crazy, we saw a lot more like fire sales. You don't see. Where fair value is an orderly transaction. You assume you're giving two willing parties time to, do a regular transaction. Also, market participants, we're assuming this is not like a related party sale. Sometimes if you have transactions, if, say someone's selling the business to their son or daughter, that might not be representative of, fair value. It's not, willing buyer, willing seller, not an arm's length transaction. Measurement date is also important. We're valuing at a point in time. Depending on when you value an asset, it can have, obviously different values. So starting off with 805, that's the standard for business combinations, purchase price accounting. So what are the requirements? Within 1 year of the acquisition, the acquirer shall recognize all assets acquired, including anything that was unrecognized previously, so everything you acquired and liabilities at the acquisition date. The fair value shall include any contingent consideration, equity interest, debt assumed. So let's say you buy a company, let's say it's 100 million, but say there's an earnout that says that you might get up to like 20 million based on how the company does. You don't just book the 100 million as the purchase price. You're going to book, and you also don't book 120 million as the purchase price. You're going to fair value that earnout. Obviously, it might not hit 20 million. So you're going to fair value that, and that's kind of your starting point. It's like, what's the total amount of proceeds that we're allocating to everything that we It also says that identifiable intangible assets must meet the contractual, legal, or separability criteria to be recognized separately from goodwill. So obviously, like a purchase price allocation, you're going to acquire, you're going to acquire your working capital, hard assets, intangible assets. Some people might just have lumped all those intangible assets into like a goodwill, but 805 says you're going to recognize you're going to break out certain of those assets from goodwill into their own assets. So by talking like trade names, other certain assets. It also says that workforce is not an identifiable intangible assets, and so you consider that as part of goodwill. Obviously, when you acquire a company, there's a benefit to having a workforce in place. Like if somebody were, acquiring GBQ, there's a value of having our workforce in place where it trains. So it is an asset, but it's not, FASB says it's not an identifiable intangible asset. Allocations also are at the reporting unit level. So sometimes you'll see companies that have 2 reporting units, which is usually like 2 different types of businesses. So you value it at the reporting unit level. I'm not going to read this whole quote. This is a quote from a former chief accountant for the SEC. But we put this quote in your packet just to say that there is an emphasis on fair value accounting. The SEC has noted it in various comment letters. A lot of people might think that you can use book value as a proxy for fair value, but it's on the SEC's radar that it's not an appropriate proxy for fair value. So common steps in the purchase price allocation. First of all, you determine the fair value of the purchase price. That's your starting point. That's what I mentioned before, where you might have like 100 million of cash consideration and you have 20 million of excess potential. So you determine what's the total fair value, and also net of any, like say you're assuming debt of 50 million, then you reduce that off the value. Then we're going to reverse engineer a DCF using management forecast, and we're going to show an example here in a minute of that. Then we're going to solve for the IRR, the transaction. That's kind of whatever makes those projections. What discount rates you need to get to the. You have a couple of this. You have the purchase price, and you have this set of projections. So there's some magic number that's going to that you can get to that makes that all equal. And then we're going to compare that against the weighted average cost of capital. And Stephanie's going to get into that this more in a minute. But number 3, we're going to determine the fair value of all intangible assets, tangible assets, and liabilities. And then we're going to determine the residual goodwill. And lastly, we're going to assess the reasonableness of this based on a few things, common sense. We always do a gut check and everything. I mean, like, is what we're getting, does it make sense? Think about company factors. And lastly, consider the weighted average return analysis, the WARA. Am I still on? What are you? Okay, so here's the IRR slide just to show you guys what this looks like. So basically, this would be we're going to look at a market participant set of projections. This is when we talk to management and we ask for this. It's usually the question to them is tell us how you were looking at this deal because we're coming in after the fact. This is like a transaction already happened. So obviously, we're coming in like show us the projections that you use to decide you want to purchase this company. Usually we're using the forecast management gave us. Sometimes it requires adjustments if there's what's called buyer specific synergies. So, just like, in like the real estate market with your house, like it's, if there's like some very unique buyer thing that wouldn't be a market participant, it's just kind of a really unique thing. Maybe you're waiting on some buyer to appreciate, your Elvis print or like, if there's like something specific, you don't include that. We're thinking, you think of what would a market participant, what cash flows could they achieve? So that goes for revenue and expenses. So you're looking at this forecast, you have, like in this example, the purchase price would have been 62, I think that says 0.2 million. So you have these cash flows, you have the purchase price, you reverse engineer it to figure out what is that present value factor that makes that, equal 62.2. And in this case, it was 20.1. So the next step in here is to see, so that was like, okay, actual cash flows, what's the IRR? Now let's do a market participant discount rate. We're going to look at, based on market participant assumptions, we're going to look at like, what's the risk-free rate? What's like an equity risk premium? what would just company risk factors be? What's like a market participant rate of debt? What are capital structures in the industry? So we're looking at like a market participant discount rate that could be applied to this company. In this case, it was 20%. Those were both in line. So basically, if you're WACC, like the market rate of return and the actual rate of return on the deal, if those are similar, that's where we're going to assume it's reasonable enough to assume that this was a market participant deal. If those two rates were like significantly different, usually the rule of thumb is like within a percentage point. So if it was, one was 20.5 and one was like 19%, excuse me, we might start saying, that's like evidence of either, on one end, it's the difference, it could be a bargain purchase, on the other end, it's an overpayment. Bargain purchases are when the fair value of the acquired enterprise exceeds the purchase price. Bargain purchases should be rare, though. Obviously, who wants to give away their company for less than they should be able to receive it in the market? I mean, just like with anything else, selling your house, like unless you're selling to a friend or it wasn't a arm's, usually you just don't sell an asset for less than it's worth unless you have a reason to. So it should be rare. And this is where if you see a bargain purchase, the first step's like check your models because there's probably something, most likely something's just wrong in your model. But there is a chance that there was a bargain purchase. And so that's where you go into a next step. But the moral of the story is just that it should be rare, if not just like, I think I've maybe seen one once, and it was a unique set of circumstances, but you should almost never see these. Prior to the predecessor to ASC 805, the negative goodwill associated with bargain purchases was reported as a pro rata reduction of the assets acquired. Now, all assets and liabilities you still record them at their fair value. You're not doing any pro rata reduction. Any excess is reported as a gain on the income statement. Okay, Stephanie's going to do the allocation. Here we go. Here, go ahead.
So in a purchase price allocation, acquired assets are going to be recorded at fair value. Any excesses recorded as goodwill. So clients hire GBQ to value intangible assets. Here's just a sample of common intangible assets that will value in purchase price allocations. Obviously, customer relationships, trading, non-protein technology are the most common. So with all the acquired assets, they're all assigned a rate of return, which is related to their level of risk. So something like goodwill is going to be least tangible. It's going to have the highest level of risk and require the highest rate of return. On the other end of the spectrum, you have something like accounts receivable, which is part of your debt-free working capital. That's most tangible. It's going to have the least risk and the lowest rate of return. And you'll look at all these returns in context of the WACC. So these are the four most common methodologies that we'll use to value intangible assets. I'll cover three of the methods in the further slides, but the replacement cost, we'll typically use that to value workforce or internally developed software. So with customer relationships, we'll usually use the multi-period excess earnings method. So there we'll want to just identify those cash flows associated with current customers. So we'll exclude any revenues related to future customers or revenues where there's no really relationship, it's an anonymous sale. So from there, we'll apply an attrition rate. We'll look at any adjustments to selling and marketing, because again, we're only trying to burden those expenses to the current customers that are associated with the current customers, so no future sales and marketing revenues. We'll also look at contributory asset charges, so charges for debt-free working capital and intangible assets. We'll look at a discount rate, and then we'll also consider the remaining useful life. Here's just examples of our schedules that I just walked through, just so you can get an idea. There's the contributory asset charges. So again, you can see the charges for debt-free working capital, net fixed assets, and any intangible assets that we've done in the analysis. Next is the relief for royalty method. So we'll typically use this method to value trade names or technology. Here we'll just want to, it's essentially the after-tax royalty payments that you don't have to pay if you own the asset versus licensing it. So we'll want to look at just those revenues associated with, for example, the trade name. When you have something like a manufacturer making private label items, you wouldn't want to include those revenues in your revenue stream for the trade name. From there, you'll apply a discount rate, you'll apply the royalty rate, and that's when you'll take into account kind of a market approach because you're looking at third-party licensing agreements that are similar to your trade name. Like I said, you'll use a discount rate, and then you'll consider the remaining useful life. Technology is something that we'll also use this method. And this is an example of what one of our schedules looks like. Finally, non-compete agreements. In this method, it's either called the lost income or the with or without analysis. And so you'll just look at the cash flows with a non-compete in place versus without it in place. And you'll make adjustments to, the revenue at risk, any type of margin erosion. And you also factor in a probability of successful competition from whoever signed the non-compete if they were to compete with the seller. Or sorry, with the buyer. And here's an example of what one of our schedules. I'll turn it back to Kelly. Okay, so I guess just to conclude on the purchase price allocations, the final part of that is the WARA. So we're going to look at, as you can see, so as you can see here, basically we're going to sum up everything we just fair valued here. We're going to have rates of return. Stephanie talked about that spectrum of risk, right? So you can see here, this actually was the example we put in here was a very risky company. I mean, normally these are pretty high, these are actually very high rates of return for assets, even like working capital. So this must have been a very, I guess, just very risky company. But the spectrum of risk. So like working capital, your fixed assets, those are kind of on the lower end of the spectrum of risk. And as you move higher up that risk spectrum, it's more risk. The riskiest of everything is being just goodwill. That's kind of just your blue sky value. Sort of synergies that may or may not materialize. So you're going to assign the highest rates to those. So all of that blends in right here to like a weighted average. So this was at 20%. So here's where, for all you auditors out there, this is kind of where you're looking, or your valuation department at a CPA firm. This is where when they're like checking the work. This is one of the things they're really looking at. Are these things in line? The WARA here is 20%, the IRR 20.1, the WACC is 20%. If they're not in line, you either have one of, a couple of things. You have like a, transaction price, perhaps it could have been a bargain purchase. Something could have been wrong in the model, or, more likely maybe you're just allocating, this is where maybe you didn't allocate value correctly to, certain intangible assets. So it's kind of like a puzzle. Basically, all these pieces have to fit together. Obviously, there's one purchase price. You have all these assets. It all works together to form, this is the rate of return.
There was only about 100 basis point difference on all of those. I mean,
Yep.
Obviously it's an illustration, but does it vary by industry, what you might call the reasonable ranges between those parameters?
I wouldn't say it varies by industry. It's across the board really that it should be like a, basically like 1 percentage point. So it could anywhere between.
So like 100, well, maybe 100.
Yes, like I guess,
basis points.
or even, it really, I think some of the difference could just be in, there's always ranges for like, was 20.5 million appropriate for the purchase price? I mean, 20 was difference, 20.4, 20.6. But that's a good question because, usually it's within, a few, like 0.1, 0.2, 0.3, but kind of like 1 percentage point would be the most you should see. So common audit issues that we've seen here. The first thing to always check, is this market participant assumptions? Is there anything that's just buyer specific in the forecast that shouldn't be included in there? Now that's not to say that kind of what's the difference between market participant and buyer specific synergy. That's not to say that like
say you as the buyer, do you plan to go in and cut some overhead and do some certain cost cuts? That's not to say that that's buyer specific, because you assume that it's reasonable, that most people probably would come in and look at some of your operating expense structure and probably cut that. But it would have to be a really like buyer specific, that only this one acquirer would be able to implement this extra revenue or extra cost. Are all forms of consideration properly valued to determine the purchase price? That a lot of times has to do with the earnout or, you know, any kind of contingent consideration. Again, my example from before, like we might see that some people try to just state it at 20 million as the earnout. You know, or they just state it at zero, saying, well, the company is like, they haven't paid it yet, they're not out anything, and they only get money. You know, the seller only has to pay it if, you know, if this earnout is achieved. But that's not fair value. Fair value would be looking at, you know, doing some kind of modeling, looking at, you could either do a scenario, the probability weighted scenario analysis, do some kind of option modeling, because obviously it's probably somewhere in the middle. Like they probably are not going to achieve all of it. They're probably not going to achieve like a lot of it. So there's always a potential that some of that are not to be taken. Third, are all intangible assets and liabilities identified? Then are all intangible assets properly valued with adequate support for each key assumption? So there's a lot of, I mean, when we get, so normally the process for this, let's say GBQ was doing evaluation for like Deloitte was the audit. We had a client like Deloitte referred us the project because, and obviously I should step back and say that this is, you know, there's a reason, you know, accountants don't, like if say we're doing a project for Deloitte, I mean, Deloitte cannot do the valuation for their client because there's a conflict of interest, right? Like you can't, you know, come up with the numbers and then also audit the numbers. So that's why, you know, they would refer us work, this kind of work. So we would do it, and then usually it goes to their evaluation team to kind of scrutinize our report. So not only are they looking at like, you know, differences in WACC, IRR, WORA, I mean, they're getting into like, you know, in that customer relationship example Stephanie showed, like, what did you use for your add back for sales and marketing? You know, which is add back we do because you're valuing existing customers, not future customers that, you know, new companies going to generate. You're buying a set of customers. So that's why we add back sales and marketing expenses. But depending on like what percentage you assume for that, I mean, that can have an impact on that value. You know, so there's all kinds of little nuances, like in the trademark, you know, relief from royalty. You know, what royalty rate are you assuming? A lot of times it's like, you know, you're assuming the rate that would be paid hypothetically if someone were to license that. A lot of times it's like 1 to 3%. But they're going to question like, how'd you come up with that? And then you have to show support too, because obviously if something generates a 2% profit margin, you're not going to pay 3% to license it. So there's all kinds of just, there's a lot of review questions that typically go into this. And also why we do, I mean, we document a lot in our reports so we can kind of show like why our reasoning behind all this. But on the audit of this, there should be a lot of scrutiny on all these assumptions. And lastly, I mentioned do the WACC, IRR, and WORA reconcile. That's a pretty one-on-one question. Anything, I guess, before I go on, anyone want to ask any 805 specific questions? Okay, so this is just a quick full-on ASC 606. This is new guidance, I mean, just issued recently. So deferred revenue, you used to kind of fair value, basically you would mark down deferred revenue. It's kind of a complex process. It was kind of, I actually like the new guidance better. But this will result in basically you're not going to mark it down anymore. So this is results in the acquirer recognizing contract assets and contract liabilities like deferred revenue at the same amounts reported by the acquirer. So I don't think it's coming out in 2023, 24, but early adoption is permitted. So just have that on your radar if you have deferred revenue, or if you're a company that has it, it might be getting treated differently on your next acquisition. So just a review question. In a business combination, which of the following must be recorded at fair value? Tangible assets, liabilities, identifiable intangible assets, or all of the above? Answer is D, all of the above. I also want to mention this PCC alternative. PCC stands for Private Company Counsel Alternative. Obviously, purchase price allocations are, expensive, they take time. I'd say the average price, call it like 20,000 for, for us to do one of these. So obviously, there's expense and time associated with that. In 2014, FASB did offer an optional amendment to allow private companies to not have quite so much work in these business combinations. So basically, the gist of it is that you don't have to break out as many assets from goodwill. So you can lump your customers into goodwill and like non-competes. Those were the primary ones basically. So it did cut down on, some of the work. Some of the companies, even if they're private companies, so we see not electing to do this, especially if you think maybe a public company might acquire you or somebody that's going to want you to have, I don't know if this is a technical term, but we call it, big gap, little gap, like big gap, like full, like gap, financial statements. So if you think like if you're at a company that's looking for maybe a public company to acquire you someday, you might want to have the fully stated financial statements because that'll look better for the acquirer. So here we have our activity code, and that is testing. The word is testing. Okay, and speaking of testing, so we're going to go into goodwill impairment testing. I can tell you, I used to do a lot of this. I've been with GBQ. We joined in 2008, so that was like just when the markets were started to decline. So definitely, like I say, our business goes in swings. Because sometimes in up markets you tend to see more acquisitions, so we're doing more purchase price allocation. And then when down markets come, you're doing more goodwill impairment testing. Now, obviously, goodwill impairment testing, you're supposed to look at it every year. But again, it's definitely more, you have more of an eye on it in a poor market. So just to give you an accounting for goodwill, pre-2001, there was no testing for impairment, you just amortized it over a 4-year period. Then 2001 to 2008, you would test it for impairment at the reporting unit level. When a triggering event happened, you had a 2-step process. And that was also 141 was implemented. That's now what's called EO5. But so that was also in conjunction with this purchase price allocation methodology. Then in 2011, 2013, a new qualitative approach called Step 0 was used, prior to testing for impairment. And so it's kind of like a more likely than not, basis for kind of moving forward with it. Now, since 2014, the new thing from there is you have private company counsel introduced an alternative to goodwill, which we call little gap, only for private companies, not-for-profit companies, including that goodwill you can choose to amortize it over a period of 10 years, and then if you do that, you don't have to test for impairment unless there's a triggering event. Impairment testing still done at the reporting unit level, but the Step 2 calculation for goodwill impairment is eliminated. So the result, kind of like, with purchase price fair value we talked before, you kind of do have a hodgepodge of big gap and little gap alternatives related to goodwill. Again, the biggest difference though is that you can just amortize it over 10 years or less if you don't want to test for impairment annually. So Step 2, the qualitative goodwill impairment test. This allows entities that you consider qualitative factors before proceeding on, I guess. So like they just think about basically if everything's, you haven't lost a major client, the market's still doing good, and your industry is still doing well, and have all these qualitative factors, that can sometimes either point one way or the other. So if it's more, the standard is more likely than not. So yes, no further analysis required. No, proceed to Step 1. Kind of key assumptions, factors, the amount of time elapsed, and the results from any recent fair value determination. Sometimes we see that, say you had a fair value done of your company, it could have been for another purpose, but like say that was 6 months ago or something, the auditors might say that's still like fairly recent, that we had a benchmark like 6 months ago, based on all these factors we've discussed, like that we've talked about qualitatively, like there's no reason to think that your market value is significantly different from that. But then again, sometimes maybe the last valuation you had was 5 years ago, and also like that you're a high growth company. I mean, that's, there's no, that's a lot of time in between. As I mentioned, qualitative factors such as economic, industry conditions, company specific events. So some of this can be, there is some, a bit of documentation that goes into that, so it's not just like a super quick thing. So to clarify, the goodwill impairment test, the step 1. Impairment exists when carrying value exceeds the fair value. So you're gonna have carrying value of 200 million, fair value is 150, whatever you have, you have impairment there. Step 1 is an enterprise valuation. So you're going to value that just like you value any company. We didn't really get into that part too much, but the ways you value a company, for private companies especially, discounted cash flow method, looking at future cash flows, discounting those to come up with the value of the company. Then there's public companies and guideline transactions. Those are just looking at other market price points. So if the public companies are trading at 10 times, we're going to adjust for company-specific factors, and maybe the right price to compare our company to is 8. So we're going to look at multiples. Same with transactions. That there were 50 transactions, that private company transactions that occurred. We can see the market price points for that, come up with the value. So you kind of look at that together, and that's how you come up with the value of the company. Again, you compare the fair value to. So here's just an example of we do it. This is what you guys saw this in the purchase price allocation, that we went through earlier. But in that example, we were, you're looking for the IRR, and that was kind of the main, that's the main focus there. Here, we're going to look at all, you should look at all methods. That was your DCF. Here's your public company analysis. Here's your transaction method analysis. Obviously, there's a lot of work that goes into like these two things. It's not as simple as just doing this, but this is like our conclusion page after all the research. And so you're gonna have all these values. You conclude on your fair value. You have your carrying value, and there's your amount of impairment. Along with this, kind of going together with the impairment testing, there's the long-lived asset impairment test. This is ASC 360. This, in my experience, is much, much harder to fail. I mean, it's an undiscounted. It's for long-lived assets. You're already amortizing. So I think that's probably why FASB makes it much harder to fail this. But because you're already, there's already some, amortization of the asset already. But, you still have to test your long-lived assets, but it's undiscounted again, so that has a big impact on, how discounted that asset should be. So some things that trigger this kind of test: decreases in market value, changes in condition, operating losses, costs in excess of original estimates. And it, again, considers the recoverability of the assets, not necessarily the fair value of it. And this kind of, the order of operations of this happens before your 350 test. So common audit issues in the warrant testing. Are all valuation methods applied correctly? Again, I am surprised by how many very smart people I've seen at companies try and do these, run DCFs, and it's kind of like why I don't do my taxes. I mean, I work at an accounting firm, but valuation is niche. Taxes are niche. These are very, there's very nuanced, application of these. So just, I guess, checking, I'm not sure if you have your client maybe try to do it themselves. There's a lot that can go wrong if you're just trying to follow something, you found online, or even just trying to apply something you've seen before. So did the valuation specialist utilize the appropriate valuation techniques? Did they only use the DCF, for example, and not consider any market methodologies? Does the forecast in the DCF make sense? So think about what we talked about in purchase price allocation. This should be your market participant forecast. It's also your base case. So it shouldn't be your best case, only if everything goes right, and it shouldn't be your worst case. This should be your base case, most likely to, you're just 50-50 chance of hitting. Our rates of return and multiples well supported. Again, we just showed the conclusions here, but we have lots of pages of analysis kind of getting to those numbers. You're not just applying a median, or like the guy in public company multiples. You're adjusting for size, for profitability, for, recent transactions, capital structure. You're adjusting for things that you need to get to make your company more comparable to these public companies. And also, do a gut check. How does it compare with the prior year's enterprise value? Does it make sense? And then, reconcile reporting unit fair values with market capitalization for your, publicly traded companies. Couple observations about impairment testing. For public company, for public companies, you should be able to reconcile that to the company's stock price. It doesn't need to, need to match up exactly, but there should be, the reason should be explainable if there's material differences. And maybe that had to do with just availability of information that wasn't available to the public, but it should be, the differences should be explainable. Company prepared impairment analysis are frequently void of sufficient support, and we often see a lot of valuation errors in there. It's a challenging area to audit. I mean, that's why most often, our work is always getting reviewed by the valuation department. That's at the other, accounting firm, just kind of people who are in it and who know, like, what are the levers to all this, what are the key assumptions, it's a challenging area to audit unless you're familiar. So review question number 2. What is not a common valuation method used when used for testing for goodwill impairment? Is it the transaction method, book value method, discounted cash flow method, or the guideline public company method? The answer is, of course, the book value method. Has no book value, may or may not have, any resemblance to, fair value. And just think about, GBQ. What's our book value? There is no, our book value would be like tables and chairs, and but that's not the value of our company. The value of our company is in our people and our relationships. Those are all things that are not stated on your balance sheet, but would be in a fair value analysis. So I think we have about a few minutes or so just to touch on equity-based compensation. So this goes way back. I remember kind of like back to Enron, where there was times, and just think about around 2001, people were issuing compensation or issuing stock options as a form of compensation. In theory, you should issue options, what we'll call at the money, and so then people have an incentive to work harder, and as the company grows, then your options, start to have value. Well, places like Enron would issue, say the stock price was at $5, they'd issue it something at lower, and it was already in the money, so you're basically giving compensation without having to report it. So along came 718. Excuse me. So this says for financial statement reporting purposes, you have to measure the expense associated with any equity compensation on the fair, at the fair value on the issuance date. Recorded over the service period, both publicly traded and privately held companies must apply. These are reviewed by auditors. There's a nice practice aid, the AICPA. It's called valuing privately held company equity securities, issues to compensation. I would recommend if you're involved in, companies with this, I recommend you have that practice aid. The valuation report must be auditable. And like everything else, which large CPA firms will have the evaluation teams rigorously review these valuations. I'm not going to get into the ways you do this, but it is, it's complex. This is not something that we have our first year analysts start on. This is evaluation 101. This is like, 405 or something. Keep in mind too that ASC 718 valuations are also, there's also like a tax component, 409A. Some of you may be familiar with, so a lot of times these kind of valuations could be multi-purposed. So the first step, determine the fair value of the company. You can use one of 3 methods. You can use, and then again, I'm not talking about just like, number 1, we're not talking about a stock. It's just one of the assumptions in valuing like the security, the option is the value of the stock. So that's just like one input of several. So, but you have to start with like knowing the value of the company. So you have to have a stock price, publicly traded, a back solve method basically. Like as if like a private equity fund just did a recent round of funding. for this company. So there's like, you have a recent transaction, it might have been on a different class of security, but you can have an option, model where you can kind of back solve into like, what's the value of this class of security? And then for privately held companies with no recent transactions to kind of back solve into, you do your normal like discounted cash flow analysis, transaction method, public companies. Next, so after you get to like the value of the company, that one input, you're going to allocate the fair value to all classes of equity. So this can be highly complex depending on capital structure. And some of the private equity firms we work with, there's a lot of classes of capital structure here. Some of those early stage companies, there's lots of levels of that capital structure. Intrinsic value method may be appropriate for simpler capital structures. The Black-Scholes model may be appropriate for securities with kind of like the basic features. So the Black-Scholes model, 5 inputs. You have your term, you have your underlying, asset value. You have your volatility. You've got like 5 main factors. So the Black-Scholes, kind of the more simpler ones. More complex ones will require like a lattice model. I'll have an example in here to show you what that looks like. Or Monte Carlo simulation may be necessary for those securities with complex features. So we're talking embedded options, down round protection. So current fair value, typical assumptions that go into that, publicly available stock price, if one, price implemented by recent offering, value of the company using typical methods. You also need your strike price. So that was the underlying value. You have your strike price, expected option term. A lot of times private equity firms, like they're usually in it, we kind of assume for like 5 years. That would be like the expected term of this kind of option. If you're expecting a liquidity event in like 5 years would be the common assumption for those things. Also, consider things like vesting periods, historical exercise, employee demographics. Volatility is a key assumption. Obviously, the more volatile, the higher the option price. If you think about it, like if you have lots of swings, there's kind of more chance to hit your option price. Just if you look at any options on any finance website, that's what you typically see. The more volatility, the higher the option. But how do you get that volatility? Like how do you decide if your volatility is 40% or 60% or 80%? That's critical about how you decide it. What we usually do is look at other public companies. You can look at the companies you looked at, the value of the company. You can, a lot of times they have options. You can look at their volatility. Also looking at expected dividends. A lot of times it might not be expected dividends, especially if they're they're kind of conserving cash to grow the business. But you would model that in if so, and then have a risk-free rate. So here's this is the lattice model example. And I didn't put a Black-Scholes in here, but that's a kind of simple 5 assumption one. So some challenges with startup and high growth companies. Most of the time when we're doing this, we are working with high growth companies. You're working with companies that like have hyper growth. So there's not, they're hard to value. Especially if you're running your normal methods. A lot of times if people are trying to do a back of the envelope valuation, how do you apply a 5 times EBITDA multiple to like a company with no earnings yet? If you're doing a revenue multiple, like, your revenue is going from 10 million, or maybe your pre-revenue, or like say it's going from 10 million to 60 million to 120 million. What do you apply your revenue multiple to? So you get into some more, these are harder to value companies. Limited track record, often difficult to find comps. So for these reasons, unfortunately, these are the companies that are often like cash strapped, but they're also like the more time-consuming, difficult, expensive ones to value. So a lot of times there is resistance. Like if you're the auditor on it, a lot of times there's resistance to this because they don't want to pay for it. But it's often the companies who need to. So I'm just going to include a couple slides. Stock prices can be volatile. You can see, just based on like just based on like when you have these highly leveraged companies, stock price can fluctuate. There's multiple audiences for this, and I'm at the 30-second mark. So just a war story to communicate. A lot of times, clients kind of try and do this on their own, and then basically then they get audited, and then there's like income tax problems. So especially like I said, there's like 409A component to this as well. The only realistic safe harbor for this is an independent valuation. That's stated on the IRS website. So, yeah, I mean, nothing, I guess, trying to think what to conclude on. We've talked about this, just, yeah, I guess just take your time with the review questions, if you're to, an audit firm that has a valuation team, always run it by your valuation team, we're always happy to help. Yeah, and that's, I think that's what I'm gonna wrap it up. So I know we're out of time. If anybody wants to come up and ask questions, after we'll be around. But I appreciate all you guys listening in. Thank you.